I am the director, one of the directors of EGROW. My colleague, Dr. Charan Singh, who generally coordinates and leads it, he is indisposed and hospitalized, but his commitment is there. He's going to attend from the hospital bed, and uh, so we have the prolific speaker today, chaired by Shri R.V. Verma ji. He had been the chairman of National Housing Board, which is very National Housing Bank, which is a premier bank for national housing. And in India and perhaps in other parts of the world, there is a housing is very important parts of the development agenda, and government gives the overriding priority to the housing sector, both rural and urban. And I will request Shri R.V. Verma ji to chair the session, and I will request him to introduce other speakers, Sunil Agarwal and Charlie Ramji, and then our friend from New Zealand. So the floor is open to Raj Verma ji. Kindly introduce and you take the lead in this.
Thank you. Sure. Thank you, Professor Ashok Vishandas ji. At the outset, I must compliment and thank the EGROW Foundation Chairman and members, founding members, Mr. Charan Singh, and you, Mr. Vishandas, for hosting this very important event. I think this is a very hot subject, and this is an all-time important theme of valuation. And we don't have actually too many programs relating to valuation and its implications. So from that point of view, it's extremely important, and we are very thankful to EGROW Foundation to have agreed to host this for a large number of participants. Well, we have very good speakers, and we are very fortunate to have practitioners from the industry. So it's my pleasure to introduce the speakers one by one. We have 3 speakers, and the first speaker will be Carmen Veselich. And Carmen is, well, I would say, an entrepreneurial powerhouse. She is founder and CEO of 2 companies, one relating to valuation, which is called the Valuation Global, which has its headquarters in Auckland, New Zealand. And she's also heading another company and founded another company, which is Data Insight. So both are related, and there is huge synergy between the two. We expect to learn from her experience in Australasia market, where they're implementing evaluation in close coordination with the financial market players, the banks, financial institutions, and the regulators. That's very important. The regulator is also on board, which gives kind of a very exceptional recognition to the need for standardized valuation and the role that a company is playing. She has been, in fact, her company has won a number of prestigious awards, international and in India too. It's called the India Fintech Awards 2019 as a Fintech Startup of the Year. They have started the company in India as well. And they have bagged a number of awards, including Singapore Top 10 Global Fintech 2018 and Microsoft ISV Partner of the Year 2020. So welcome, Carmen, and we certainly look forward to hearing you on your very rich experience in the international jurisdictions. It's my pleasure to introduce Sunil Shaligram. Sunil is actually the national head of the largest mortgage lender in the country, national head of project finance and technical services, HDFC Limited, which is the largest mortgage lender in the country. And he has been with them for nearly 30 years, heading the project finance and technical services department of HDFC. He is responsible for sourcing and managing project finance and real estate lending of HDFC. His responsibilities include evaluation of property developers, debt financing for real estate projects, and evaluation of trends in the real estate market. Shaligram is involved in the functioning of subsidiary companies also of HDFC, namely HDFC Ventures Trustee Company Limited and HDFC Capital Advisors Limited as its director. So welcome, Sunil, Shaligram. We have a third speaker who is Sunil Agarwal. He's the founder of Black Olive Ventures, a real estate advisory services company. He has a very prolific experience in the space of education also in the real estate sector. He was the co-founder of South Asian Real Estate, a private equity-backed real estate development firm. He also served as vice president at a private equity firm, ICICI Ventures, and has held senior positions with HSBC DS Group, Colliers International, now JLL. He's currently National Council member and faculty of Institution of Valuers and member on various committees of real estate related funds. So welcome both Anils and Carmen. It's a pleasure to have you all here, and I'm sure we can look forward to a very exciting session. But before I do that, of course, we are missing Dr. Virmani, the chairman of the EGROW Foundation, who is an eminent economist and earlier chief economic advisor of the government of India also. He brings with him immense experience, and his presence would have been a source of guidance for the deliberations and interactions also. Ashok ji, you can convey our that we missed him for this session, and I'm sure we can catch up sometime later. Now, this is just to give a little introduction about the topic. Well, as all of us know, housing is the most universal product, which is always in demand and which will always remain short in supply. So it touches the lives of all the people, sometime or the other in their life, and is the biggest asset for any individual. So to that extent, the decision making of any individual for buying a property or for acquiring a property or for constructing a property is very, very critical and key. And that decision is largely dependent on the price of the unit, the price of the property, how is it valued, how much equity he will need to bring from his side, whether he's in position to bring that equity at that particular point of time when the price is low, or he'll have to wait for it, by which time the prices may go up. So it impacts the borrower in a big way. The valuation or the price of the property impacts the borrower in a big way. It actually has implications for his affordability in terms of the extent of loan that he can get, which will substitute for partly for his equity at least, or whether the lenders would insist on very high equity, which means they will be giving a low loan to value loan for that particular property. So denominator, which is the value of the property, is extremely critical. And that's something which has been very relevant and hot theme all these years. And we know that there's been a lot of reforms in the economy, in the financial sector, but somehow the reforming the real estate sector or reforming the, I would say, the real economy, the construction side, has not really kept pace with the reforms in the financial sector. So that's where the disconnect also lies. And in all these reform in the real economy, in the real estate sector, valuation is absolutely central subject. It's a central theme. So buyers, for buying their properties, they have to decide when to buy, how much equity they have to bring. The valuation is what needs to be done by professionally. So the entire mortgage industry ecosystem comprising of the borrowers or the buyers, the lenders, the valuers, and within that segment we have the brokers also, who are now regulated under ERA as well. Then you have the builders. All this is one set of the ecosystem, and the other side is the regulators. So when when property is valued, or we have seen internationally also, the general notion that property prices will always keep going up, will always move northwards, is a very, very dangerous myth. We have seen over the years and across the globe, the property market, when it crashes, it takes along with it the entire financial sector. We have seen the global financial crisis of 2007-8. When it happened, the entire financial sector, it became a financial sector crisis. Moreover, it became a sovereign crisis. So it engulfed within itself the entire globe. So the regulators are not for no significant reason that they are very wary about the movement in the property prices, in the real estate prices, and when they see that there is overheating of the market, they intervene very proactively through various kinds of prudential regulations, both macro and micro. So this being the platform, where you have a large number of players coming in, and you have the whole ecosystem of the mortgage industry, and then regulators who are playing overarching oversight role, it makes a very complex kind of a system, and the sector gets even more complicated when we look at the valuation as a very opaque, non-transparent, non-structured, non-standardized, and highly diverse practice in the industry. So that raises a lot of concerns. So it's very important to bring in reforms in valuation. And I think the role of all these stakeholders is important collectively. And that's where I would, in fact, flag the major issues being on the real estate side. We have the lenders' capabilities, or the mortgage lenders' capacity to handle this, but they handle it rather, I would say, conservatively. The regulator also, though regulators have allowed high LTV loans, the lenders are conservative, and which eventually impacts the borrowers. The valuation of and all this happens because there is uncertainty around valuation. So that gives to be on the prudent side, the lenders will like to be conservative. The regulator also, since there are uncertainties, there are non-standard, ununiform practices across the industry, across the country, and across the valuer community, across the lenders community. So it doesn't give the right kind of confidence to the regulators also to be able to handle this, better. So regulator also always is kind of on the edge when the issue of real estate and housing sector comes in. Our country has done well in channelizing funding for housing, which is the other part of the story, and which is a good story, and which is quite incredible. The total, in fact, mortgage penetration in the country is very high, though as a percentage of GDP still have to go a long way. So as far as funds flow is concerned, there are a whole set of banks and the specialized housing finance companies who are very positive on the housing sector, particularly lending to the individuals for the housing loans, and the NPA in the housing sector, individual housing loan segment being low, the lenders have enhanced their contribution in a big way, and that has been supplemented also by the government's initiative on providing subsidies, etc. So that is one side of the story. Other side is the real economy, the real estate, and where today we have assembled here to actually take stock of where we are on the important issue of valuation, and how can we take it forward as a part of the reform agenda, as a part of reform measure. So with this background, I would request the first speaker, Carmen, if you could, you have a presentation with you?
Sure. Yes, I do.
So the floor is yours.
I'll just share screen.
Sure. Yeah.
Fabulous. Thank you.
Right.
Wonderful. I'll just see if you can see that. Thank you very much, Firma, for that wonderful introduction and overview, which is very, very great for setting up as I'm going to speak. Can you see my screen? Can you see the PowerPoint? Is that clear for everybody?
It's blank right now, but why don't you put one of your slides?
I'll give it a minute. It should be coming up. Let's see if it comes through now. Let me know when you can see it. Is it showing now or no?
Yes,
sharing it.
yes, it's come now. Yeah, you can make it full screen.
Okay. All right, wonderful.
Yes.
I thought it was. Is it not full screen?
Make it. No, it's not full screen.
Okay, I'll just see how I do that. Won't be one moment. I thought it was show active speaker video.
Yeah, it's okay now. Go ahead.
It's okay now? Okay. Yeah, I think it must be somebody driving on the other side because I can't control it. That's fantastic. Well, thank you everybody for having me, and greetings from Auckland in New Zealand. And thank you, Mr. Verma, for that fantastic introduction and overview, because we all recognise the value and the importance of property valuation and data analytics in mortgage lending. So I'm just going to see if I can, oops, there we go. So as Mr. Verma said, property is the most valuable asset in the world, and certainly it's growing very rapidly in the Indian market, and contributes a vital part of the overall contribution of India's economy, and it's expected to be up to 13% of gross domestic product by 2025. So significant growth in housing, significant growth in the property bank market segment, and in the loan against property continuing to grow. And when we look at these large numbers, we recognise the crucial importance of making sure we're capturing adequately the value of these assets transparently, and understanding what is happening with property market, with stock, with the economies. In other markets that we're working in, such as New Zealand and Australia, property is still the most valuable asset in the world, and we're seeing significant growth as well through significant demand. Mr. Verma touched on the global financial crisis, and we've certainly seen around the world two growing frictions that are happening in the banking sector. The first being increased regulatory compliance and the need for best practice lending that has quality control, that has benchmarking, that has valuation frameworks, and that adheres to best practice, so that the regulators can feel comfortable that the decisions that the lenders are making that affect the economy, that affect homeowners, that they're making really accurate decisions as much as possible. And in Australasia market, we're certainly seeing a significant increase in compliance and the level of requirements that the regulator is requiring at the time of loan, and also so from origination, and also from the portfolio perspective of maintaining that portfolio for provisioning. At the same time, we have this friction that customers are expecting everything to be faster and everything to be easier, because that is what's happening with other products that they're using. It's quick, it's easy, it's digital experience. And so when they come through to their mortgage application process, the home loan application process, there's a lot of friction, and we're starting to see obviously a growth of fintech and a growth of digital, and the need for digital and technology to brace that increased friction of more and more things to do for compliance, but also wanting to go faster and have a more efficient and more seamless customer experience. Is my slides clicking through all right?
Yes, that's fine. Please go ahead. Please go ahead.
Can you hear me? Oh, fabulous. So there's significant challenges that we're seeing, certainly in the Indian market as well as around the world, that require continuous innovation. We can't keep doing more, increased values, increase increase compliance without adding innovation and technology and data to achieve those outcomes. So some of the challenges that we're seeing across India are stalled and delayed housing projects, unsold stock, unaffordable property. And unaffordable property is a very, very big topic in New Zealand and in Australia as well, with increased responsible lending and concerns around the household debt levels as they're continuing to increase, the liquidity crisis of developers, the need for transparency, particularly for the home buyers themselves when they're investing in their largest asset, and the need for transparency and understanding what is the market doing, particularly even more so in a COVID market where we have volatility and stop-start, as we've seen across all markets over the recent year. There's concerns over housing bubbles, and certainly in New Zealand, no one expected our market to continue to increase as it has. And in India, there's significant concerns. How do we even know if it is a bubble? And how do we actually know when it's actually inflated, when the developers are pushing up prices without the right data to have visibility on that? A shortage of trained quality valuers. And this is another global phenomenon. In New Zealand, it takes 7 years to become a valuer. So we do not have people studying to become valuers. And more, we're having to look at alternative valuation models where even for the last few months, we've continuously had delays to get valuations completed where a valuer inspection is required because of the significant demand for actual valuations, as we're seeing our property market growing significantly. And we know in India, the shortage of trained quality valuers to understand what is a trained quality valuer and what is that measurability to understand who is able to perform a valuation that is reliable. And then the home ownership problem. So there's a projected housing shortage, a significant number of units, which is obviously going to continue to cause housing pressure. So multiple challenges on top of that significant growth that we touched on. We have many global lessons learned in India and indeed around the world. And Mr. Verma touched on the global financial crisis, the need for digital efficiency. Every business, particularly in a COVID world, is recognizing to be digitally connected because we no longer can operate all going into a bank or all working in a head office situation. And digital efficiency, as well, along with the increased cost of actual employment workforce, is something that's obviously a significant trend that's accelerating. Regulatory compliance is not going to go away. And there's obviously, with the most valuable asset in the world, a duty of care to actually continue to monitor, to maintain, to measure. And so more and more, the outputs that lenders are required to do as part of their housing portfolio will continue to evolve and to grow. And that's where we see the increased role of technology and data, because all of those things are only possible with increased technology and increased data. And I'm sure we all recognize the value that technology can bring and that data can bring. And I'll touch shortly on some examples of how we're actually really seeing this accelerate at scale. And then I think that's also going to be an exciting topic to discuss at the end with some questions, because it's never been a more exciting time to be working with property, with technology and with data. And we've seen a significant growth in fintech investment. So quarter on quarter, every quarter, the number of investment that's going into fintech, into financial technology to make all the different parts of banking faster is continuing to increase. And certainly for the valuation space, this becomes a crucial need where we can leverage some of those other technologies to help us go faster and have increased visibility and transparency in the market. And then one of the other things that I would be remiss to touch on is the impacts of COVID. and sorry to hear of the member dialing in for his hospital bed. I'm incredibly impressed at your dedication today. That's absolutely phenomenal, and we hope you're enjoying the session and you have a speedy recovery. We're all affected by the impacts of COVID, and certainly a property market, when we freeze a property market, and then we're forced to come out again and understand what is going on in the market. The need for data to actually run a new indices post a lockdown and understand that to see where has the market moved since the lockdown started has never been more crucial. And that's some of the things that we've worked on across the world. So to rely on evaluation and to rely on the property market and make these decisions, we talk a lot about global best practice, and that is where we do most of our work. We work a lot in our technology as a valuation platform, and it's really been created through the regulator down in Australasia, where they were very concerned around the quality of valuations. And so the regulator added new rules, and there were three particular things that they actually mandated for all lenders to do. The first is random valuer allocation, and that was to remove collusion. So there was a lot of fraud and collusion uncovered where the person in the branch knew the local real estate agent, knew the person buying the home, and they colluded together to inflate the valuation of that property and then sell it for a profit. And so random allocation of the valuer became one of the rules that the lenders have to follow in Australasia. The second one is quality control and then ongoing performance management. So how do you as the lender know whether this valuation is right or wrong, and whether you can rely on it? And so to actually deliver that, the quality of the valuations, removing subjectivity, adding evidence, so comparable properties sold, their location, are they inferior, are they superior, and what was the date of their sale, as well as adding risk flags. Are there any risks the lender should be aware of here that we might not be able to tell without you actually stating this? And so all of those things got brought into the reports. And through that information, the lender can also needed to do quality control and ongoing performance management. And so capturing whether the valuer had delivered a good valuation or not, and where they didn't, making sure that that valuer was removed from their panel. And that was very important to capture that and have consequences. And certainly some of the consequences that we saw in the Australian market, where Genworth actually sued a number of valuers with their PI cover over losses, really brought that home. And that was a few years ago. In order to actually then manage your policy, it also required a digital credit policy to remove subjectivity and maximum efficiency. And this is where we've done a lot of works with lenders where they have pages and pages of a credit policy, and we've digitized them to say, if this, then this, if this, then this, and remove any activity for concentration risk, for anywhere where they're going to say no, trying to move those rules earlier in the process. So we very much talk about the right risk at the right time and making data-driven decisions, because certainly some properties are low risk. The loan ratio, it may be the loan to value ratio may be very acceptable, and it's possible to make a faster decision versus a more complex property. And in order to scale this, obviously, when you have lots of branches, that digital efficiency becomes crucial. So it was very much one of the biggest trends that we're seeing and focused on is regulatory compliance in parallel with improved customer experience. And that's what a better valuation and a more digital valuation can enable. And out of the back of that, we've also seen a strong collaboration of lenders. And this is where it's exciting to have so many lenders today on the EGROW webinar and talking to the quality of valuations and the importance of this in mortgage lending. Because where we've got to in markets like New Zealand is we have all of the lenders together, and we all agree valuation standards. And these valuation standards become the bank's valuation standards that every valuer, regardless of who the bank is, has to follow these standards. And Velocity is the platform. It's our job to actually capture this and measure it, and we serve that back to the lender. And we can see which valuers are not following those standards and need ongoing training and ongoing education from their institutes and their associations. And so it's incredibly powerful to see the transformation over time, but particularly around valuation standards and quality of reports, and that setting, that quality setting that is driven by the lenders. So all the lenders, senior lenders meeting together, and that actually standards being adopted by the entire industry. So, we're very excited to be working in the India market, where we see this exciting transformation of going from manual to digital, which is really the transformation of valuations for property lending, bringing digital process and an end-to-end workflow, importantly, enables data capture. And that's a crucial part. You can't capture data and start doing quality control and start doing analytics if you're not actually capturing the data digitally. So moving away from PDFs to actually digital templates. Obviously, one of the other growing trends that is more and more important is the secure privacy and sharing of information. And actually, we've seen last year and the year before a very big incident in Australia where one of the valuation firms lost all the data of a bank's customers applying for valuations through this valuation firm, and the regulator and the privacy officer, and there was strong investigations. And so ensuring that the connectivity of a valuation is all private and secure and that customer information becomes also very, very important. Automated benchmarking. So we see in manual markets where we're working, where there's little or no quality control because the market's very much in an emerging market, automated benchmarking and aggregation of data becomes really powerful. And I'll just jump to the bottom two, the geocoding of addresses and digital capture. And, very interesting when we first started working in India, when we started talking about quality valuations, everybody would say to us, but what about the data? But what about the data? The data isn't good. And we spent a lot of time trying to find data. And what we realized was there is no data. And that was a really key point to recognize, actually, to do all these things of best practice, it comes down to quality data. And if you have rubbish in or unvalidated data in, it's very hard to then do portfolio analytics and all those powerful things out. So it was fundamental for us to introduce geocoding of addresses and validation from the valuer, and then digital capture, which enables all the magic to happen, which I'll touch on in a moment, but including indices, trend analytics, and portfolio monitoring to understand what has actually happened and the trends, and start measuring performance. And what we see in the more mature markets like Australia, where valuation has been actually mandated through a platform for around 15 years. So everything is very, very digital connected. They actually have an agreed language for valuations, electronic language when they're sending valuations between valuers and banks. And so the whole process is very digitally connected. We've seen a growth in a hybrid model where on the right-hand side, we've got your full market valuation inspection, which obviously, for the first valuation ever, you need to send a valuer to make sure the property is even there and validate and inspect that property. In New Zealand or Australia, and also for projects in India, once the valuer has already visited the property once, to actually do ongoing updates of that property, the attributes do not change. The bedrooms are the bedrooms, the bathrooms are the bathrooms. So once you have that data, once you have that property in your portfolio, whether it's a project or you're existing and wanting to do a top-up loan, then the valuer can do a desk valuation, is what we call it, where we have a very bespoke template that we create with the banks. It has risk flags, and the valuer valuation for the area that he specializes in, the locality that he knows, and he just updates the value, and he still has to provide comparable sales, but it's much faster. And in Australasia, it takes about 4 days for a full valuation, whereas a desktop is within hours. It's quicker and it's faster. All the way to the left, where we have automated valuation models, where actually for homogenous properties, we're running those across portfolios. It's always on, and it's instant, and it's incredibly powerful because it can very much drive the bank's decisioning around the loan to value ratio at the beginning of the process, to understand whether you're even going to say yes before you move to the other side of actually getting a valuation. So in the New Zealand market, for example, lenders will lend up to 80% with an automated valuation model if the quality is good and the property is homogenous. I touched on the need for quality data, and one of the most important things we realize is not every market has good data. And so it's very, very important to enable the tools to capture and create that data. And Velocity Connect is a tool, an example of something that we've created for the Indian market, to allow valuers to actually capture information in the field digitally, to timestamp the photos that they take, to geotag the coordinates of the address and the property, so that we know we're actually validating the address, and we know on that day, at that time, that property was worth this much. And we know, is it a project? Is it a house? Is it agricultural? Is it commercial? And we can then, going forward, do the powerful benchmarking and quality control. And that allows a faster process, but importantly, it allows quality data to be captured. And the importance of data is the most important thing. I know, as you'll probably guess from Mr. Verma's introduction, I have a whole data company, so I am a data geek and very biased with my view. But the data is the most important thing, and it's the most powerful thing for creating really, really powerful value going forward, because you can't do portfolio monitoring without that robust data-driven decision making. And so, you need the accurate and timely data to monitor the risk. And so, as an example, when we went into lockdown in New Zealand, we started running a COVID indices of properties sold post the first lockdown to understand how much had the market moved. It's then important to be able to operationalize your credit policy through your technology. And it's the power of combining digital technology and data with an always-on view. And so the power of dashboarding at the moment, of actually building portfolio indices to understand what is going up, what is going down, what is staying the same, what is happening with new stock and new flows, and that overlay of the macro market is incredibly powerful to give you the context of how your portfolio is performing. And without that, you don't have the context. And so we're doing a lot of work with automated valuation models, but also with proprietary indices, because each bank will have their own bias. Your brand, your lending policy, your location, loan that you do, you all have your own bias of customer. And so you need to understand how your portfolio is working. And that's where a proprietary valuation indices for your own property and portfolio is incredibly valuable. And then benchmarking that against the market to understand what it means for your bank, and very much that so what. The value of timely decisioning and transparency cannot be underrated. I remember the global financial crisis. I'm showing my age. I said to one of the lenders, "What do you wish that you had known?" And I always remember he said to me, "The horses were bolting and no one wanted to be that guy who threw himself in front of the horses and said, 'Oh, I think we should stop.'" And because the market was going up and up and up, everyone was reaching their KPIs, getting their bonuses, very excited, and no one saw what was coming. And it was very much a highlight moment that it's so important to have timely and transparency visibility of the market. Lastly, I want to touch on collaboration, because each of you, especially the lenders, the valuation firms, public data, ourselves. We all have data that we're capturing. And on its own, its value isn't really realized until we have collaboration, aggregation, and insights. And when I say collaboration and aggregation, it's not necessarily sharing individual people's names and details. It can be streets, it can be suburbs. There's ways to work these things, and we've seen it happen globally. And we see it with bureaus, with credit bureaus. But the power of collaboration, collaboration around where you're seeing risk, where you're concerned, quality control, aggregation of information and insights is incredibly powerful. And that is the power that we have today, all on this EGROW, to be discussing shared issues and shared opportunities to improve the quality and transformation of valuations. It's important to recognize reform is transformational. And I guess, that's very much the slide that I'm going to finish up with to allow time for questions is improved efficiency and improved standardization with automation brings improved regulatory compliance and growth to the market that is really sustainable growth, because you have transparency on the quality of that growth and you have visibility to make data-driven informed decisions. And so the future is very much ours to create. It's an evolution, not a revolution, but it's one piece of the puzzle at a time and adding more and more. Because if we don't start, we will never get there. And so I think it's a very exciting time with property and what's happening in the India market. And I think it's never been a more exciting time. And so it's more prudent than ever for us to look at how we can have the best policy, how we can have the best data, and how we can be leading best practice to actually transform and be the transformation that we would wish to see as a group. So thank you, everybody, and look forward to questions.
Yeah, thank you. Thanks, Carmen. That was a very, very insightful presentation. I think Ashokji, we'll have questions at the end of the session after all the speakers have finished.
Yeah, when every speaker has spoken, we open the floor for the questions towards the end.
Right. Yeah.
Thank you.
So it's been again a kind of re-emphasis on the need for standardization and uniformity across valuation and making it more transparent. Just to capture the sense, I think we need to know that in India also a number of measures have been taken over a period of time to de-risk the sector essentially, and which can mean a whole lot of market infrastructure establishments, like you have the credit bureaus for the individuals, you have the property bureaus for in terms of SASAI. So you have a credit guarantee, trust fund, you have the mortgage guarantee corporation. So there has been an effort towards de-risking the sector from all angles. While there has been a lot of focus and drive on the dream project of housing for all, it can turn into a regulator's nightmare actually, and for the reasons that we just saw, and particularly from the valuation angle. So when the property market throws up a lot of distortions, and which are difficult to explain, for example, the volatility in prices, etc., difficult to explain. So that's where a stricter and more stringent and more proactive regulations come in. So there is a need for further reform and improvement in this sector, and I think we'll have to learn while doing. We have made good headway in this direction. We have a fairly large set of valuers whose maybe capacity will need to be developed and promoted to become more digital, and to develop a really end-to-end digital mechanism without any. It's a seamless experience for the customers, and of course with due regard to all the regulatory compliances. So those are the, of course, major areas, and let's see how we move on from here. There has to be initiative from the industry, and I think we are very much there to take it forward. So with this, I'll request our second speaker, Sunil from HDFC. Are you there, Sunil?
Yeah, I'm there.
Sunil Shaligram from HDFC. So may I request you to share your thoughts and experience with the participants and with all of us?
Yeah. Thank you, Varma ji.
Thank you.
Good evening, everyone. I think Carbon has given a different angle. She was talking about more from a home loan perspective. I will give a different outlook because I look at a project funding. So the challenges for the valuation for the project lending, I will touch upon that more because she has covered a lot on the home loan sector anyway.
Right.
Very interesting. This thing in her presentation, I found one thing which was very interesting is the challenges faced in New Zealand and the challenges we are facing in India. I think are more or less same. I think I was under impression that probably some of the challenges what we face in India may not be there in New Zealand, but in her presentation that came out very clearly, saying that those problems are same. Okay. So with this, I will start my presentation. I will start my talk because I don't have a presentation as such. See, it is very critical to assess the value of the real estate asset. Okay, if we are looking at funding the project or giving loan against the property. Okay, why it is necessary is to understand the value because the quantum of loan depends on two factors. One is the credit appraisal of entity, and the second is the value of the property. So when I'm looking at funding the real estate, it includes the valuation, and which is a very critical function. Okay, and when I'm looking at valuation, then I need to get into a whole lot of things, which is what is the sales which has happened in the project, what is the investment of a developer, what rate he bought the property, what rate he's proposing to sell the property, and all kinds of angles, taxation kind of thing. I will have to get into all, and then finally I work out a valuation. So I think when I am getting into this, it is a very I will have to get into lot of factors which I will have to consider. Valuation in real estate is very difficult because every property has got some unique features. Such the location is one feature, the size of the project is another feature, the floor plan, the amenities, and the general real estate market. The scenario in the real estate market at the particular location, the demand and supply, all those things play a very important role when the valuation of the property has to be done. And that's the reason there are a lot of subjective elements and judgmental elements which are there in the valuation of the property. And that's the reason it depends on a lot of qualitative factors as well as quantitative. But quantitative is very easy to get into. Qualitative is a judgmental thing. And that's the reason I'm making a statement. There is nothing wrong and nothing right in the valuation. If I'm doing a valuation of a project, I will do a valuation of the project is X, and somebody will say it is 2X. I will have my own justification why it is X, and somebody will have a justification why it is 2X. So I think that's where the judgmental factors and the qualitative factors play a lot of role in doing the valuation of the property. And that's the reason it all depends on a valuer, how he's justifying the valuation of the property. And I'm not getting into it's a very large subject. I'm not getting into too many details, but valuation is also depending on various for the purpose of valuation. If I'm doing a valuation for buying the property, the valuation may be different. If I'm selling the property, the valuation can be looked at differently. So if I'm leasing the property, the valuation will be different. So I think the purpose of valuation, if I'm doing for the tax purpose, the valuation can be done in a different way. So I think there are different purposes of valuation, and then the valuation may vary depending on the purpose also. From the perspective of a lender, why it is important? One is, you see, as an institution, I'm representing as an institution. from my institutional purpose, for the capital adequacy purpose, risk weightages, and provisioning, as per the new Indian accounting standards, if I am providing on certain account, I need to get into valuation. And the fair market value is a very, very critical thing for in doing all this provisioning part of it. And that's the reason the valuation plays very important role today in the as per the new Indian standard accounting practices. Then, as Vermaji rightly said, now the regulators have also insisted upon getting the valuation done from in the independent agencies. So, from a regulatory purpose, also I need to do that is very important. That plays very important role if in our industry, that I need to get an independent valuation done, and which also gives me what is the security cover available for the loan what we have advanced. So I think these are the important things from a mortgage business. These are very, very critical things which we look at. As you know, all the real estate projects, all the real estate mortgages are secured by properties, either in form of land or in the form of building or under construction properties or whatever. And as I said earlier, I am also doing the credit appraisal, but I am also looking at the valuation. And why I am looking at the valuation is I am looking at a risk of a default. If there is a risk, if there is a default, how I am going to recover the loan what we have advanced. And I think from that angle, it is very, very critical that I get into the valuation. And that's the precise reason the correct and realistic valuation of the property is important. Typically, the project loans or the home loans are a long-term loan. If it is a project loan, it is something like 4-5 year loan. If it is a home loan, it is something like 10 to 15 year loan. So I think the value should be sufficient so that at all points of time, the outstanding loan is getting covered with the value of the property. And from that angle, periodic valuation also becomes necessary from the mortgager's perspective. There are instances in the past where the valuation has dramatically come down, but there are those kind of instances in Indian market are few, but it has come down. Like in 1995, the property prices came down dramatically. It came almost half. In 2008-9, the property prices there was a significant drop in the prices. So I think your valuation and the cover should be such that your loan, what you have advanced, is sufficiently covered at all points of time, and it takes care of all these kind of eventualities. Like there was a flood in Chennai some 4-5 years before, and I think the property valuation dramatically went down. So the valuation and the cover should also take care of. The cover should take care of that, and from that angle, the valuation is very important. So as per regulatory, this saying periodic valuation is necessary. Revaluation need to be done at a timely interval, and at all points in time, the loan to value ratio has to be looked at. Earlier, in some I think 4-5-7 years before, I think most of the institutions, including our institution, we were doing the in-house valuation. But what has happened is RBI and the National Housing Bank has now made it mandatory that we should get the valuation for a property beyond 1 crore. The valuations need to be done by independent external agencies, and those valuers, there are criteria which are specified. There is the Indian Bankruptcy Board. So you need to have the valuers which are registered with the Bankruptcy Board, and there are exams which are conducted by them, and they should be qualified. They should be registered. There is a process also which is very, very clearly spelled out how to empanel those valuers. So I need to have a empanelment of the valuers done, and I need to carry out the valuation from those valuers only. I can't have a situation wherein I go to any valuer and get the valuation done. I need to get it empaneled. Okay, so that is very critical as far as the guidelines which are issued by RBI and the NHB is concerned, and they are very specific. Valuers need to be independent and should not have any direct or indirect interest in the value in the property or with the institution. So that is very clear. So that kind of undertaking is supposed to be given by the valuer. And the periodicity of the valuation is also has to be a board approved policy of that institution. So typically once a year. So suppose the institution decides that I need to do a valuation every year, 2 independent valuers report are required to be taken for each and every outstanding loan, because that has to be a board approved policy. So NHB has very clearly and RBI has very clearly specified that. And if there are situations, suddenly if a situation like say Chennai floods or like cyclone comes in and the valuations are impaired, then the periodicity has to be changed and immediately the valuation has to be carried out, and the covers and all need to be verified. So that is what also the guidelines spells out very clearly. So as I said, the valuers need to be registered with Insolvency and Bankruptcy Board of India, and there are extensive guidelines which are published. What is how the process, what is the curriculum for exams for these valuers, and what is the process for empanelment of these valuers. Basically, I'm not getting into too many types of valuation, because there are valuations which are done with different methods. But as an institution, any lending institution will look at basically 3 kinds of valuation, and I will touch upon it. In which situation that kind of valuation is looked at. One is a distress valuation. If it is a distress valuation, so typically if the loan has gone, it has become a non-performing asset, and I am trying to sell that asset either through a process, legal process, I am trying to sell the property, then typically the valuation which is done is because at that time the property is in distress. So if the valuation, typically the valuation which is done is a distress valuation, which what is the value we'll realize by selling this property, because not necessarily every property will fetch a market rate. If the case has gone bad and if it is a non-performing asset, then typically the distress valuations are carried out just to understand what is the bare minimum amount which we can recover from this. When we are giving the loan, which we are sanctioning a loan and disbursing a loan, typically the as is where is valuation is looked at, or a fair market valuation is done. Okay, as is where is valuation is probably the better mechanism when we are lending, because it gives a fair idea what is the valuation as of today. It doesn't take into account what is going to happen, whether the rates, property rates are going to go up in the future, the property rates are going to go down. Those kind of things. Typically what happens is in India, all the time the valuers were looking at a situation where the property rates were going up all the time, and the realization is to be better. So if you look at any valuation, even if it is done by any method, discounting cash flows or whatever, people used to take an increase in the property rates over a period of time. So they used to also take the increase in the cost of the property, but they also take the increase in the property rate. What has happened in last 7-8 years is the property rates have not moved, but the construction cost has moved, the interest cost has moved, but the realization has not moved significantly. So I think, at every point in time, if I am doing the as is where is valuation, so at least I know what is my cover, what is the how my loan is covered from the valuation, rather than going into futuristic valuation. Another problem in the futuristic valuation is, see, typically if there is a project of say 5 buildings, a builder starts a project of 1 building, 1 or 2 buildings in the initial stage, and remaining 3 buildings he says I will launch as in the second phase. What happens is, based on the market's feedback, the second phase completely changes. The type of flat changes, the composition of flat changes, so everything changes. So the valuation what we have done in the initial period, saying that there are 5 buildings of this type, which actually undergoes a lot of change. So he instead of doing instead of doing a project which is a exclusive project, he may go for an affordable project. So his profit margin comes down, his valuation also comes down. So I think somewhere down the line, this also has to be taken into account when we are doing the valuation. So, and that's the reason I am saying, as is where is valuation is always better, because I am valuing 2 buildings are under construction. I do that, and the rest of the land is a free marketable land. I do a valuation of the land on as is where is basis. I don't get into what he's going to do in the future there, because that future what he's going to do may change. And the third valuation is the fair market valuation. If everything is good, the developer, the project is performing, the project is the loan is a performing loan, the project is ongoing, and I want to understand what could be the fair market. I can get into that. There are different valuation method which people use, market comparison approach or discounting of cash flow. But in what happens in our scenario is, see, there is a developer A who is extremely good and who is he's working in a premium segment. He may come out with the product which is, and he's going to sell the property at say X rate, and there is another developer who is doing affordable probably next door, and he is selling at say X minus something, a significantly low rate. So it becomes very, very difficult. So market comparison also, see, the developer who is selling at higher rate, he will say, no, I command a premium, so you should do a valuation based on my rate rather than doing on somebody else's rate. The next door fellow is selling at lower rate, you can't do valuation on that rate. But when in a distressed kind of a situation, probably the land will get sold at a adjoining project's rate rather than a premium rate. And I think that has to be considered. So these are some of the challenges which we face in market comparison approach. In a discounting of cash flow also, there are issues which the developers think that the project will get over in say 4 years period, and we know that there are projects which are going on for 7 and 8 years time. Okay, everything had changed. The assumption for the rate of interest has changed. The duration of the project has changed, and the cost of construction has changed. The realization has changed, and then then the original assumption is no longer valid. So I think then in a discounting of cash flow, every time doing a discounting, but every time the time frame is anyway going up. So I think that is the challenge in the discounting of cash flow. So the best thing in all these valuation, as the RBI is specifying, is at a regular time interval do the valuation, understand all these factors, take into consideration all this, and work out what is the security cover which is available to you. Are you covered, or there is an impairment in the value of the security? And if whatever are the corrective measures need to be taken, take it. And that's a precise reason. This is the guidelines which are issued by the government, the RBI as well as the NHB are very, very important. I think that is one good thing which has happened. The market is evolving over a period of time, but this is very critical, and every institution is now trying to follow. Better days will come, because this system will also stabilize over a period of time, and we will be able to see a better valuation. What are the challenges which we face in doing the valuation? First of all, I think unlike in say New Zealand and Australia, what she was talking, data in our context, getting the credible data itself is a bigger challenge. The registration data is not available all the time, not necessarily in all the states. The CERSI data, the lenders data is not available because everyone is keeping the data to themselves. And the secondary data which is available may not be reliable. So I think that is a major challenge which we are having. Okay, the developers on their own also do not share the correct data because they are worried about the competition. They are worried about giving information, giving a true picture. So I think that is also with RERA now updation of the sales data is compulsory. With this, we hope that some changes will happen, but it is currently getting a credible data is a big problem. The second thing is that there is no standardization of the data, because if CERSI is capturing a data in certain way, The lenders are capturing in another way. There is no standardization data. The property addresses are not properly captured in a specified format. So because of which it becomes very, very difficult. There are unit of measurements are not standard. So in some cases, somebody says it is square meter, somebody says square feet, somebody in the most of the agreements it is mentioned as carpet area, someone says super built up area, those kind of. With RERA, now it is again on the carpet, but the standardization has so far not happened. Still you will find there are different areas which are mentioned, and the units of measurements are also different. The values are also not mentioned correctly, so that is the big issue which we are having. There are a lot of factors which are based on the DCR, land use, title, encumbrance and title, the encumbrance in the property, the legal issues are not known. So I think that has got a bearing on the valuation, which we don't come to know. And then there are who is the seller, who is the buyer. I think you know, if a seller itself is in a distressed condition, the valuation can be different. If a seller is in a better position, the valuation will be different. I think those things are also need to be available, which are most of the times which are not available. There are so many other details which are required in the valuation, which are not available in the data form. So it becomes very, very difficult. Registration data in most of the states is in the regional languages. So that is also one of the challenges which everyone faces. Then the data available from the registration offices, even though it is in certain states, everything is computerized, but still the data availability is a big problem. The circle rates and ready reckoner rates are not as per the market. There is a lot of variation between the circle rates and the market rates, and you know, those are the challenges. And one major challenge which we face as an institution is non-availability of the registered valuers at every center. So suppose we want to get done some valuations in say a city like Coimbatore, we find it extremely difficult to get a IBBA registered valuer in Coimbatore. So it is not possible. So then you know, then you will have to go to say Chennai and get a valuer who is registered, but then we really don't know what is the kind of quality of valuation what we will get. So those are the challenges which we face in getting the valuation. As I said earlier, some of the other things which all the valuers and we were used to it all along, the assumptions which we were taking in while doing the valuations. One is prices going up all the time. So this was one factor which is common with the valuers, which actually they take into account. Today I am selling at X rate. Tomorrow, at the end of 1 year, I will sell at say 5% increase, 2% increase. But there is no kind of a concept which is there with the valuers, which says that the property, the rate may not move also. The rate may remain stagnant, which we are seeing for last so many years now. The rates are more or less stagnant, which actually is not the assumption when the valuations are done. Then the challenge, what I said, is the timing of the project and the complete duration of the project. So everything, when the valuation is being done, the project is assumed to be completed in 3 years' time. It takes 5 years, it takes 7 years. I know some of the projects which are even launched in 2008 are not yet complete in Bombay, which is very, very difficult. What kind of valuation will get in this kind of situation? The changes in the type of project, changes in the complete nature. Part of the project is converted into commercial, part of the project is converted into IT park. If there is a project which is of IT park, suddenly there is a residential building comes up. So it has got bearing on the valuation. So these assumptions in the initial stages, whatever are done, which are no more valid. And I think that is a major challenge which we face. And you know, typically in the project funding, if these kind of things happen, the developers also need to come back and inform the institution saying that I am doing these changes. Not necessarily every time it is communicated. So you know, the very critical information of changing the project, nature of the project, or the product size or the product type of product is not known to the lender. Okay, stalled project is one of the major factors which I saw in her presentation also, it was mentioned stall project, which is a major problem which we are having. And in stall project, the value dramatically falls. The project value dramatically comes down, and that is a. And these kind of assumptions are not there at all in any of the valuation which is done. So if today also I have seen so many valuations of the stalled projects which are given, thinking that the project is ongoing. Okay, one major assumption which is missed out in the by the valuers in doing the valuation is the interest cost. And what happens is, when the valuation is being done, the valuers need to take into account what is the outstanding loan on the property, and that loan will carry a rate of interest of say X, which will be to the till the end of the project, and the additional loan what he is going to get, and that will have a bearing on the valuation, which is not accounted for at all. So the valuer doesn't get into what is the loan outstanding, what is the rate of interest, how much additional loan he is going to take. Those things are very, very critical when the valuations are worked out, which are not there at all. Okay, so I think these are some of these assumptions which are not there in the valuation, which is a major problem every financial institution faces, because a valuer doesn't take into account all this. Okay, and one last point which I thought I will just cover, which is on the automation. What she said in New Zealand, what is happening, the same kind of thing which have started happening in India, which is on the retail front, where most of the lenders now are having their in-house valuation process, and the valuations are done using some tech platform. But it is in a very, very nascent stage, but it is being done. But the major problem what I covered, which is on the project funding or property related non-individual loan business, which is not there in India, because there is no automation here, because it depends on a lot of judgmental and qualitative factors, and which we unfortunately today we do not have any automation being done in this area. So I think with this I want to complete what I wanted to say. I will be happy to take questions, because I would have actually liked more interactive question and answer session, but it's okay. So if anyone has got questions on this, I can probably share my practical views. Thank you.
Yeah, thank you. Thanks, Sunil. That was a that's very hands-on experience, and thanks for sharing with us. I request Mr. Ashok Vishendas ji would like to say a few things.
Thank you, Verma ji, and thank you, Mr. Sunil. You covered a lot of ground and added a new tangent to the whole gamut of the evaluation. And you correctly raised the point of the data quality, and same issue was raised by the Carmine also. And I see if data is tortured long enough, it can confess anything. Mm-hmm. So you can interpret the same data in a different way. So the quality of the data assumes a lot of importance. And Sunil, you remind me that Adam Smith, he says that we do not get the dinner because of benevolence of the butcher, baker, or brewer. It is because of their self-interest they come together. So the point you raised, that, for instance, you gave a very interesting example. A builder raises the point, one particular tower, and then he tests the water, and then depending on the response, he manipulates or he calibrates the prices for the second and third tower. So those are the gimmicks, and there is no standardization of the measurement of the area. There are different versions, super area, the carpet area, and so on and so forth. I'm sure this was a very, very good presentation you made, and it touches each and every one of us. In fact, each and every citizen of this country. So because housing, but I will request Vermaji to hold the question towards the end. Let the third speaker also speak, and then the floor for question and answer will be towards the end, if you agree and Sunil also agrees. So
Sure,
this
sure.
is just a,
Sure, we'll do that. That's how we had structured when we discussed with you that
Right.
after all the speakers have finished their presentation, then we'll have a Q&A session. So thanks again for your views, Vishendas ji. And Sunil, it was a great presentation. It did talk about, you see how the market is fragmented still. And the valuation, there are so many different aspects of valuation, starting from the lender's own due diligence, then market value, and you have the guidance value of the government, you have the circle rates, you have distress value, you have realizable value as a security, and then you have the accounting standards coming in also. But accounting standards still, Ind AS or IFRS, it assumes, or rather it is premised on a good valuation market. It is actually premised on the assumption that there is a market which will throw up right valuation. So the whole accounting becomes highly valuation oriented. But somehow that disconnect still is there, because on the supply side, we are seeing there is a very fragmented approach. There are judgmental issues, there is subjectivity. As a result of that, the values are so amenable to manipulation. Values are so amenable to different kinds of interpretation. So that to bring in objectivity, transparency, and then uniformity and standardization across all these, individually lenders could be doing that, but we need to have a system at the aggregate level, which is very important and which actually throws up the trends and which throws up the right kind of a market price. We still feel that, say, on the developer side, project side, where there are stalled projects, but prices don't come down. The individuals, it's not amenable to market forces as the financial sector is. So and then you have the consumer market versus the investors market. There are certain interests which keep the prices up, even though the property is unsold. As a result of that, the bank's loans or the HFC's loans also can get sort of jeopardized. So there are a whole lot of issues on the pricing side, and particularly when we are looking at the projects, and those projects where individuals are buying in. So ultimately, we have to deal with a much stronger regulatory regime. You have the ERERA discipline coming in now, but still has to stabilize. But the fact remains that today's there are reforms in valuation is absolutely critical and important, and which will actually have very transformational and far-reaching effect on the sector, improving its efficiency and its competitiveness to attract more funding. So thanks again, Sunil, for all that, and very hands-on experience you shared, which I think all of us can relate very well to that. So with this, we have the third speaker. May I request Sunil Agarwal of Black Oli Ventures. Sunil, yeah, please, floor is yours.
Yeah, I'm just going to share my screen. Just let me know if you can see that.
Mm-hmm.
Yeah, so is the screen visible to everybody?
Yeah, yes.
Okay, and the full version now is visible to all?
Yes.
Okay, wonderful.
Yes. Okay,
so,
go ahead.
First of all, I'd like to thank EGROW because it's a very prestigious forum, and I feel very happy to share the dais with some of the most eminent people. Mr. Verma, you've been the head of the NHB, which is like the RBI equivalent of this sector. Carmen, obviously, an entrepreneur at the global level, cutting edge of technology. And Sunil Shaligram, obviously, we all know, has been with HDFC. He's built, he's grown, he's built HDFC as a bank, and I feel very, very fortunate to be in this company. Coming to, what I would focus on, and obviously the last speaker always has the benefit that a lot of what would one want to say has been said. But from a valuer's perspective, I just wanted to sort of come up with a viewpoint, and I think it resonates pretty similarly to what Sunil and Carmen have said. But let me begin by saying that, just a step back in the memory lane, and I'm reminded of when I joined real estate in '95. The scene was very different. Parallel economy, there was a lot of parallel economy which is not there today. So obviously what the bankers lent was already hedged, and therefore almost the lending happened at the distressed pricing if you give an LTV. There was hardly any competition. Prices always went up, and at least that is what was the myth in 95. Bottomless demand at all price points because housing was in short supply. Walk the market did the trick. So the market was not big enough. And as we all say in real estate, that walking the market is what makes you aware. Even walking the market is important now. The walking in the market, then you could cover the market pretty much, on a visit to a certain area. Small ticket sizes and customers very sensitive to default. Legal environment was challenging. So I think HDFC was a pioneer when they started to sort of, look at the regulatory regime, but still kind of went ahead with this, lending of real estate, which wasn't very common. 85, 86, 87, 90s, people really were giving loans at a very high interest rate. And there was little deployment pressure. So that was the most wonderful years of what lending was. And valuers also. I mean, if there were some could write any value, could get away with murder. And that is how the scene was. Now, what changed? What changed now from 2005-6 onwards is that, parallel economy story started getting out. There were a lot of people in service who were now buying houses. They found it difficult to arrange cash, and therefore they would pay everything accounted for. Competition kicked in between the bankers, and there was obviously a time when you went to the bank and the TAT or the turnaround time for a file was maybe a week, 15 days. Now that is 24, 48, 36 hours. Prices also went down, and I used to work with a company called Colliers, and we did a deal in Bombay. It was Madam Kama House, which later on had the Jet Airways, very classic building. In 95, 96, JP Morgan bought that building at about, I think, 30,000 or 40,000 rupees a foot, which was a very, very expensive price. And 10 years later, they sold it exactly at the half the price. So, that was a wake-up call that, yes, property prices can come down. Commercial property doesn't sell for twice the value of the residential. This is, again, myth that was broken because in Nariman Point, residential values started to become better and the commercial offices started to sell for lesser value. So a lot of, the myths were broken. We always said then that, real estate may kabhi oversupply nahi hoga. You won't have a situation in India where there's oversupply of real estate. There's such a lot of demand. And now you see there are markets, especially in the larger cities where you see oversupply. Even in smaller cities like, Chandigarh, around area, you had ghost towns being built up by developers. Then I think complicated products emerged and new geographies also emerged. There was a time in about 2005-6 when Bangalore disbursement of mortgages was about 80% plus, if I'm not wrong, 80% plus of what was disbursed in the whole state of Karnataka as a mortgage loan. So the bankers really did not push themselves up. The life was very comfortable and they did not explore boundaries. Customers are still sensitive to default in this country, which is a saving grace. And then there is a better legal environment. So things changed. Life became a little more tough for both lenders, valuers, everybody in the system. And because of that, I think, and now again, there is another thing which, we face as valuers and the industry, maybe professionals working, is that there's something called deployment pressure. In 2005-6, when private equity hit this country and, lending was still is and will continue to be the king within any industry, the term deployment pressure never existed. Then there were a lot of other people coming in, and in order to deploy more and more, and you saw more institutions in the form of HFCs, NBFCs enter the fray, and you see now there is a lot of lenders in the market, and therefore I think what I'm connecting and why I did go down that memory lane was that there is a need of more valuation skill. There's a need of more data analytics to happen at this point than ever before in India, because today the set rules of property prices going up, property prices will never come down. There will always be short supply. All of that is broken. And I think within this regime of so-called pressure deployment and increased market, I think one has to learn to live with it. And I think the only way forward is to build tools and systems so that we are able to better our valuation standards, better our delivery on data analytics, and as an industry grow in the whole process, because I think the demand is still a lot there. Challenges, I think, very aptly put by Sunil Shaligram, and I think the fact is that in India, we deal with a lot of property types, which I haven't seen in a lot of countries, especially the more organized countries. UK, led the valuation standards globally. America, a lot of these developed countries. You see a picture of an old city, in Calcutta, and you have Chandni Chowk in Delhi, and you have Bindi Bazaar in Bombay. So within Bombay, there are typologies which are old cities, which have a dynamic of their own. Multiple ownerships, at times, properties, boundaries not defined, the kind of floors and very complicated, stories there. There are fantastic layouts, good new colonies cut out in the outskirts, periphery, but the urban fringe itself is a big problem. Some of it is legal, some of it is not legal. Then you see a colony towards the right. This is like an urban village, and this could be illegal or legal colonies, and then there are apartments. So I think to add to the complication is that while there are valuation challenges enough, the typology is of a type where a flat within a building itself is very unique, and therefore the property price may differ. In Bombay, the top floors are respected, and in Delhi, the top floors don't sell, and vice versa. So every market has its own, cultural, dynamic as well. So I think this is one challenge where I think both the valuation community and the lenders are learning. And I think the new rules are being written to sort of go about doing valuations in uncharted territories, which, initially I think, the market was only to more cleaner kind of properties. But now I think with more mortgage demand from the other markets as well, there are other markets which, lenders are and values are now testing waters with. Bylaws in this country obviously are, every state has its own bylaw. Every architecture book will tell you how much is the super area, what you can build above FSI. There are markets where you can build everything within the FSI. There is fungible FSI in Bombay, which is a new concept, which will held a lot of market for a number of years. Area calculation, every building would have different area represented to different people. So the built-up area versus the area that is given to contractor versus the area that is sold is all different. And I remember the nightmare that as a developer, when I had to maintain many Excel sheets, one for the contractor who also had to build the basement. By the way, that was free of FAR area and did not come under built-up area because you had to sell parking separately. And that was the most expensive part of what we built. But we did not have realization and things like such. Construction practices and costs can be very different. We do have offices in Bombay, Delhi, Bangalore, everywhere. And in Bombay, the buildings next to the sea have a very, very high cost structure as compared to the ones which are not near the sea, because some of these buildings would require piling, foundation, and things like such. So costs within a city could be very different. And obviously not to mention that with typology and with specifications and myriad number of things, these increase. Permissions and sanctions and costs associated with sanction. I mean, one thing is that a developer can show you a receipt of 20 rupees per square foot I paid as a legal fee, but there is a lot of other costs that go into administration and other things, which sometimes is very difficult for anybody to justify. But post, entitlements, there is a value. Pre-entitlements, there is a value. And that, I think, creates challenges for valuation and the lending community. Again, there are legal issues. I mean, rent control hasn't gone away in all the cities. Also, urban land ceiling has not gone away. properties are being transacted in this country. You know, it could be illegal, it could be quasi-legal, it could be extensions and what have you, and there are demolitions that take place, but at the same point in time, there is a rampant violation of bylaws. And sometimes when you go into these markets, different banks, different NBFCs have different policies, and you see a building, you know, two buildings in this picture. One, there is a demolition happening, and if a bank, by the way, had lent to it, then you know, there is a huge amount of issue. So there are different practices. Some banks say what is built illegally should not be accounted for in valuations. Other banks do account it because they say that we will take the risk of, you know, whatever. So the risk appetite is more. And, you know, you see a building which is, you know, taken from one of the valuations we did in Noida. It's a 6-story building in a urban village, and the permitted floors are only 3. So, but this building is sold and it is bought, and you know, people feel that it cannot be demolished, and there are different views about who can take a call on these buildings to fund which floor, etc. So there are challenges not only on property types but what gets sold. I mean, there are many extensions of flats we see. People make an extra room, and that whether it's to be valued or not. I mean, arguably those properties also sell for a higher price, but as a banker, will you take the risk of funding against them or not? As a valuer, will you put that value down on paper? Are some challenges which I think exist in this market. Real challenges, credit issues, again, parallel economy still is a big issue. I mean, if you have registered rates which are at a certain circle rate, and circle rate, as Sunil said, do not have market reality at times. They could be very high or very low as compared to the market. You will get registrations at that rate, but is that something which is the value? And you know, in South Delhi, we recently started to do post-pandemic valuations, and we saw that the circle rates were higher than actually what the property is available for, and a lot of transactions did not happen in the market just because if there is a tax authority that will come knocking at your door, what do you answer to that tax authority? Even if you would have paid you know, you had paid the stamp duty, etc., as per the bylaw, you can still attract a taxman. So a lot of things, you know, go into what is the credit issue. Then there is something called dominant community effect. I mean, you had a Jain community which will live in a certain area, and no offense to any community, but the effect is that, you know, you will see property disproportionately higher in value in those Jain enclaves. So, you know, sometimes that is difficult for a valuer to explain. Again, there's one thing that we've noticed, uniform LTV for all kinds of properties. I mean, this is something which has led to a lot of frustration, both in the lending community as well as the valuation community, because there's a case which is, let's say, 100 crore property or a large value property in a prime area. If the LTV is the same, then I think the value will not go through, because the chances of a prime property trying to go down may be a little more, it will be more hedged than, let's say, peripheral location of, let's say, a commercial property. And such kind of uniformities, if they exist in the lender's side on policy, can lead to a lot of frustration and distortion, and valuation becomes a challenge. And I don't know why, but there is one thing that happens in the lending community, that the valuer has to always increase the value to the point that they can lend. But the call that there's a rational investment committee which can take a call depending on the type of the property is absent. So sometimes there are these pressures. I mean, there are times when our firm was not given work here on, but that's fine. I mean, but these challenges do exist. Again, very rightly put, I won't go into details. Authentic data and use of analytics is absolutely absent. And when we were doing these valuations, our firm did some projects in US. There was a very clear distinction on broker's opinion versus a full appraisal. And these things have been defined. However, what we try and do it here is some bit of a mixture where we go to a broker, take his opinion. Some valuers prefer to write that. Some will have their own norms and things and such. So it's a calculated guess is what we try to do with this country. And there is a very low incentive to adopt technology, because a lot of these valuation business is not a high fee paying business, especially at the retail banking level, at the retail fee level. And even at the construction finance level, fees are not that great, and a lot of these valuation firms do not have the ability to sort of raise the bar and put a sophisticated technology system, which is why I think when Carmen and Velocity, sort of put this system in place, I think a lot of valuers will go down that route, because I think there is this incentive that somebody invests in technology, but a lot of valuers in the industry has a barrier not to sort of being able to afford it. Very, very few firms in this business have a turnover of $1 million plus, and that is, again, should tell you the industry status. Again, lack of valuation standards. What IBBI currently does is says that please practice international valuation standard. Which one they don't specify. You can go to Tegova, you could go to Redbook, you could go to international valuation standards, which is the most commonly practiced. However, I mean, things are laid out beautifully in that book, but they still need a guidance note on the India mortgage valuation, because the practices here are so different. And again, across the lending community, across the valuation community, there is something called a rule of thumb that works. And one such thing I would like to point out is that, profit of a developer is always 20 to 30%. Now, if the project is finishing within 6 months or a year or 5 years, he cannot expect the same rate of return. I mean, you will have to value and account for time value of money. So, we first of all practice a rudimentary method called the residual valuation. And then the residual valuation, you just assume at the end that there is a profit, irrespective whether the project is completed in 5 years or 6 months. And that is often a point of debate. And somebody will have to justify it with time value of money and a rate of return that is reasonable for the market to expect. So, as Sunil said, these are all, elephants in the room. And, we always tell our, client that we are doing this valuation because if this property were to get a default, what is the open rate at which it will be sold in the market, and not exactly what the funding rate of that specific property or that specific developer or that specific. So let's get out of specific subjectivities and put this property in a default situation in the market. And if that's the value that it can fetch, that's the value it is. So, and I think this cost method or income method, there are, always reasons why I would use one, and we'll come to that later. But I think Indian problems need a little bit of Indian solution, and there has to be a guidance note within the international book or an Indian valuation standard that has to emerge and recognize that there is a mortgage market which, works fairly differently in this country, given all the challenges that I've explained. So again, there is one thing that we always face as a valuation community. What are we? We are a valuer, we are a forensic expert, we are a lawyer, we are a credit manager. We don't know, because the expectation is that a valuer has to read the documents and, give the legal advice, no matter how much the legal, lawyer of the firm that is hired, he's probably more hedged than a valuer. A valuer has to write comments, and sometimes the lenders don't like when we write comments, because those comments can lead to negative remarks. So there are different kinds of lenders. I mean, there's some lenders who will say, write the comments, whatever, and but these comments, whenever we write, I have seen that if we don't write even a small thing, there are penalties that come our way. In one specific case, it was a khasra property, and we wrote khasra number so and so, but in the comments it did not say khasra property, and the banker was, so I think there is very little policy, very little standard, each one to his own or her own, and expectation out of valuation is also very different. I mean, and we'll come to that and see how. Again, this whole thing that Sunil Shaligram was saying, and I think a lot of people may think that registered valuer is what every lender is looking at, but SBI, which is also one of the largest lenders in the country, came out with an empanelment document which did not recognize 34AB, did not recognize registered valuers. For a category of valuers or valuation properties, they would go to a diploma pass civil engineer, not even a civil engineer, diploma pass certificate holder, and he was allowed to do valuation. Some insurance firms do not respect valuers in this country. They have their own exam. You have to pass their exam in order to do those valuations. So if you're a valuer, then for insurance, you pass another exam. For 34AB, you have different credentials. For registered valuer, you have a third exam, and then there is a lender who may have his own criteria. And there are, so as a valuer, your life is tough because and then there was a law passed by in some cases where somebody said you must be a master's in valuation, which is a degree that is offered by one college, which has produced 300 graduates over a period of 15 years. And there is a university which does it almost on a, online kind of a, or a part-time basis exam, which most of the banks say, sorry, we don't recognize it. So does a valuer have to then go outside the country, pass an exam for 4 years and come back and do a practice? And this time extension has been given. I think it was expired in 2020, which has been extended 2021 and so on and so forth. So there is no common, criteria. So some banks respect 34AB because they find that their lawyers ask them a report to be signed if in case there's a litigation, income tax notice should not come. There are others, but 34AB is for that. Registered valuers are recognized only under the Companies Act. They're not recognized under the Income Tax Act. So as a firm, and as a valuer, I have both now applied for 34AB. We've also got somebody myself registered valuer. Then there is a certain exam that we are also trying to sort of pass for insurance valuations and so on and so forth. But why can't this be one registered or one qualification which applies to everybody in the country, like in the case of doctors, like in the case of engineers, like in the case of insurance or any other profession, chartered accountants, etc. But that's a situation. Again, I'll just try to address one thing, and then I think we'll just quickly wrap this up. Valuation is about not only just a value. It is about what approach do you use for valuation for what you want to. So purpose becomes the most. I mean, as a firm, we never value anything. We do not take up an assignment if somebody says, I have a general purpose and I would want you to value. We don't take up that valuation because value differs from the purpose. It has been discussed, debated nationally, internationally, but that is, so purpose is very important. Not only purpose is important, there are two more words if you look at the slides. One is what is the premise of value and what is the fundamental measure of value. And I think there is a huge distinction between those. Fundamental measures, are you saying market value, market rent, equitable value? Now, there's a difference between fair value and market value. And I think the common term in finance parlance is fair market value, which is equivalent to market value and valuation standards. So I think there are all kinds of terms being loosely used. But if you look at the global standards, most of them will have equitable value as the fair value, which is when both parties are getting that benefit, which is not applicable to market participants. So there is a value defined there, investment value and synergistic value and liquidation value. So what are you measuring? And as Sunil said very rightly, that banks look at probably three of them: the distress value, the market value on as is various basis, and then the market value. Again, when you look at these values, what is the premise? If you're developing a project, is it always the highest and best use, which is called HABU? Is it the current use? Or you're doing an orderly liquidation where you're giving time for people to assess and then bid, or there's a forced sale liquidation? So it's a complex matrix of what you want to value for what purpose and what's your premise. And you could have values which could be very apart. I mean, there was a Government of India valuation we did, where the value of the property was of 5 crores to 75 crores, depending on how the assumptions were made. This is Government of Bihar trying to buy a property, buy back its own property, which they had given to the client, which was the tourism department, ITDC. So it was their land. Somebody had built a project there. Now, ITDC said, sorry, I don't want to run this hotel anymore. So the value of what they had built, if somebody were to look at the salvage value of that, was 5 crores. But if they had to run that hotel the way it was a ramshackle hotel, it was probably valued 18 crores. But if somebody had to, do that refurbishment and run that hotel, probably the value may get up to 35 crores. But if Bihar government decided that we will demolish this completely and give permission for not a hospitality project, but maybe a a shopping mall or a commercial complex or what have you, the value could go up significantly. So, there is no valuation which is there intrinsic in a property unless the purpose or the approach or the premise of the value and what is it that you're trying to value is clear. So I think, in some cases, when the valuation comes, we would have to ask this question: had there been a uniform standard that was being assumed across the board, I think that those kind of questions will be laid to rest. And that is where it is so important to have these valuation standards. Very quickly, in our, assumption, as far as lending community is concerned, there are three kinds. My way or highway, I'm taking the risk. So why are you playing the spoil sport? I don't need your value. I just need to top up. I need a certificate. And these, lenders treat valuers with contempt and arrogance, give the work to the cheapest, the most compromised service provider. That's a reality of life. The other kinds say valuer is a genie. He's my Superman. I don't know about real estate. I know my banking. But if anything goes wrong, Mr. Valuer, you are the one who's responsible. So they're fair weather friend. They stop giving you work. They debar you. They do not collaborate with you. But they're better than the former ones. There are lenders, and there is increasing majority of lenders now, which is treating valuers as partners. And that is where there is a collective learning. They positively incentivize valuers and believe that there's a collective learning. And this is something that we need. We need a trust which is there between a valuer and a lender. And that is what is missing today in the market. When we go out, there are, and unfortunately for our firm, we are empaneled with 85 customers. We probably enjoy a cleaner reputation, but there is always this sword which is there, which is now increasingly valuers and the lenders are collaborating. But the scenario in some pockets is still extremely trust deficit and huge amount of trust deficit. Again, as a result, what happens? There are good 20% valuers. Sorry,
Sunil, quickly.
Should I just stop now?
No. You just finish it quickly.
I just finish it in 2 minutes. Right.
Yeah, sure.
So, one, who do not want to be valuers, two, who have no willingness to upgrade, and they are the ones who may have built a successful business, but they don't want the next generation to keep up. And that's 80% of what valuation community is. There's 1% or 2% of valuation community that wants to be in this business, and that is how the sad situation is. I mean, a lot of this data that is suggestive. I'm part of IOB. No firm has ever come up for membership of IOB because people don't want to build skills. There are some firms, handful of them, 30, 40, who may have registered with IBBI. But if valuation as a profession has to survive in this country, then there is a lot of things that we need to do. And that's something that I would just want. Adopt Indian valuation standards relevant to Indian markets, adopt a valuers bill. There's a huge need of training, both of valuers and lenders, either side, to understand this elephant in the room called valuation. I personally feel that there is a tsunami of opportunity in India. GDP will grow. Market size can actually be even 5-6 times in the next 10 to 12 years. And mortgage GDP ratio is still small at 10%. I think for a developed economy and the way India should see, it should be between 20-25%. So all these factors, I think, there's a huge potential. Peri-urban areas, village areas, second homes, these have not started to happen in India. And I believe that the way forward is that you will have specialist financial institutions. You've seen the economic, people have set up a shop for so-called affordable housing, and there is a housing that is done, the lending done through another book, which is of larger properties. I think there is a lot of asset classes which need to be added to mortgage. There's a lot of geography which needs to be covered. So I think the future is, as I say, faster, further, higher. And with that, I end. So over to you, Mr. Verma, and thank you. I think overstretched a little bit.
No, that's fine. Absolutely. Excellent presentation, Sunil. I think it was very, very informative. And we all know that valuation as a discipline has still to evolve. Vishendas-ji, may I request you to say a few words on this presentation?
Yeah, I'm really delighted to listen all three speakers And the fourth, I will say Sunil also was intervening, though he was not formally speaking, but his intervention was very, very useful. And a person who is not expert in housing, it gives a lot of insights into the housing sector. So each of the panelists, Sunil Agarwal, Sunil Shaligram, and then our friend from New Zealand, Carmen, wonderful presentation. Let me admit, I'm not a housing expert. I'm though economist. My expertise in international trade and agriculture. But let me make 2-3 things. Which is agitating my mind, if I can use that word. A few points you said. That there is a lack of standardization in terms of measurement, and in the valuation, the ratio could be 1:15, because the same property worth 5 crore by one valuation can be valued at 75 crore. That's a huge difference. Now, let me ask on this point. Suppose, of course, one is the purpose which makes it vary, and for the same purpose, if the value the persons who values it are also different, will the same kind of variation will be there? That is question one. And second, the mortgage to GDP ratio as of now is about 10%, which is expected to go up to 25%. So that's a huge number. So what are the drivers of this increase, which is likely to increase? Somebody has anticipated this. And in the New Zealand, Cameron, I just one question. You have listened what are happening in India. I'm sure similar things may not be happening in New Zealand. That's my hypothesis. Can you throw some light on this? What are the best practices in New Zealand and elsewhere? So this is my question, but of course, I will reserve my thanks towards the end. But I must tell you, I got a quantum jump in my understanding of the housing sector. Thank you.
Thank you, Ashokji. That's very, very nice, nice of you. First question, I think any of the Sunil can answer on
I think I'll just take up this first question, which Ashokji said. I think if you give the same set of assumptions, the valuation by far should not exceed more than 5%. That is how I would like to sort of go ahead. However, just as an international practice, if you value REITs and investment properties, see, investment is very specific to the person who makes that, and his, investment criteria could be different. So there, for valuation of US REITs, they accept a variation of 15% also, which is to us a very large variation. But for the mortgage market, if the variation is more than 5, 6, 7%, I think there is a cause of concern, or there's a missing data, or there's a missing information, which can only lead to that kind of a difference. Otherwise, the valuation should be in that range. On the
so short answer is that yes, it may still vary, but if it varies beyond a certain range, then there is issue. We need to be more sort of alert and alarm.
On the mortgage to GDP ratio, I think Sunil Shaligram is more qualified because they do a lot more studies as a valuer. But
let Sunil respond.
Yeah. Okay.
Sorry, on this,
Sunil,
I understood the question only.
Yeah, what Ashokji was mentioning was that we are today, say, mortgage to GDP ratio is about 10%. Actually, Vishendasji, what's happening is we have a very good flow of funds into housing. Every year, it's about 4 lakh crores. Now, 4 trillion INR, and today's mortgage outstanding is close to about 20 lakh crores, which is about 20 trillion INR. Now, with this kind of flow happening each year, we are expecting that with this, the GDP will keep growing substantially. I mean, the mortgage penetration will keep growing substantially as a percentage of GDP. So on a ballpark figure, assuming that this kind of flow and the incremental growth in housing continues to happen the way it is happening, we should be reaching a good about 20-25% of GDP by 2030. That's what one of the estimates has said. But of course, it's open to question based on certain assumptions, and assumptions are fairly realistic, and they're based on the actual trend over the past 7, 8, 10 years. The housing sector growth story has been good, and that's been very encouraging. That's where the government support also has come in a big way. And with that happening, we expect that the mortgage penetration ratio will be very high. In other countries, developed countries, it's anything above 60%. It goes right up to 70, 75% of the GDP, housing sector. But then there's a downside to that. If anything really happens in the housing sector, and that's penetration being so high, at such high percent of GDP, the whole economy can get dislocated. So we, in a way, we were saved because our penetration was still very low. And of course, apart from the regulators being very alert and proactive, but we still have some, I mean, it didn't really get impacted so badly because the housing sector's contribution to GDP or mortgage GDP was still very low. So that was, anything you have to add, Sunil?
No, I think you covered a lot, everything. Yeah, thank you.
Then institutional depth also has been there. Today we have a large set of lending institutions, housing finance companies and banks who are, the quantum jump every year. So with that, the overall flow of funds is good. Can we open it up to the participants?
Can I ask just a clarification? My name is Devi Manjunath. Mr. Sunil Saligram. The two things. One is that about Mr. Raju Verma was telling about the 25% increase in GDP for the housing sector. What do you feel about the project funding? Any guess work?
No, project funding in the, anyway, project funding nowadays is going up every time. Most of the banks are also doing project funding. If you notice, I think there are a lot of specialized institutions also came in for the project funding, and then if you see after COVID, a lot of last mile funding institutions have also come in. I think there is a lot of project funding which is currently available, either from banks to housing finance companies to NBFCs to last mile funders. So, project funding is every project is actually being funded now currently in most of the big cities like Bombay, Metro. Every project is a funded project. I don't think anyone is not relying on the project fund.
What about the startups as such?
No,
startups?
you are not clear. You are not very clear because
what he's asking is, what about the startup projects, the new projects?
Project funding.
Startup project funding.
What is happening is it is easier. If you ask my frank opinion as a lender, I will tell you it is easier to fund a startup project than a project which is somewhere in the midway, because in a startup project you can have your assumptions very clear, and then you can decide the quantum. You can look at the financial closure and do a funding, rather than getting into a project which is halfway. There is an existing lender into the project. This is actually a startup project is very easy. Unfortunately, what is happening due to COVID, the lot of not new projects are coming up. The whatever are the funding opportunities which are available for all the institutions, which are actually refinance opportunities. Very few projects have been launched in the recent times. That is the concern. But otherwise, funding a startup, new project, a greenfield project is easier compared to getting into a ongoing project.
Just to add to that,
there was one interruption actually when you were talking. You were telling about some redressal talk about the aspects of the readdressal, the valuation reports or something which was missing or something. There was a network issue with your network issue was there. Can you please repeat that?
Who are you asking? Sunil Agarwal?
Sunil
Saligram.
No, it is.
There was an interruption.
Yeah, for a moment there was some interruption.
That he was telling about the redressal on the valuation reports, lacking something he was telling about.
Well, I think we will be circulating the recording of today, Mr.
No, that-
Manjunath.
No,
Yeah,
that was
so
an
tomorrow.
interruption was there, sir. There was an interruption
so,
was there.
Yeah, but let us
Even
not
if you
repeat what
circulate,
is.
it will not be clear. Even if you
Yeah, I
circulate,
understand.
that aspect will not be clear.
No, but we
Okay.
will make out, but he
Okay.
does not remember.
Okay,
There is
fine,
another.
fine. No problem.
Yeah,
No problem.
so bear with that.
Yeah,
There is
definitely, definitely.
there is a question on the chat. One Mr. Choksy is asking, can I read, Vermaji?
Yes.
Yeah, there is a question by some of the audience, which is on the chat. Can I read it? Or
Please go ahead. Please read it. I'm not able to.
Yeah, Mr.
figure
Choksy
out.
is asking, regulation of valuers has been a need to mitigate the risk from lender point of view. At NHP, you had initiated, this question is directed to you, Vermaji. At NHP, you had initiated some action by introducing a handbook of standard practice. I do not know if there has been any progress on regulating valuers and their profession.
Yes, Sudhin, that's a good question. It takes me back in time. We did start on that. And at that point of time, actually, there was a talk about RERA and the government's own legislative draft bill for RERA, which was coming up, on which we were having a lot of discussions with the Ministry of Housing. So that's where it got into the background. But the idea was that to bring about some kind of a standardization. Even that exercise wouldn't have been perfect or complete, but at least a beginning would have been there, which I think I left as a work in progress, which was later taken up by in the RERA bill, and that's how that got a little deflected. But yes, we had started that, and standardization was, as part of regulations, we were extremely wary about the diverse practices in valuation, and much of the prudential norms were linked to whether it's the risk weights or capital adequacy or provisioning or even default rates. Everything was so linked to valuation, and the valuation was very divergent from lender to lender and from valuer to valuer for the same property. That would have meant, in a way, some kind of a regulatory arbitrage. So as a regulatory institution, we were very uncomfortable with that. And that's why we were trying different kinds of things. We tried to develop Residex also, Residential Price Index, and RBI started doing on the Housing Startup Index. So all this together, it was happening around the same time to notify to the industry that this is a concern of the regulators and they need to take adequate precaution and be alerted when the property prices keep going up. So to one of the speakers' point where they said that it's very wrong to assume, it's a myth that the property prices will always keep going up. That's something which has been exploded a number of times, that myth, in the international jurisdiction also. And we have had very rich learning from all that. Any other questions? Let's say.
Yeah, there is another question to Sunil Agarwal. Lakshmipati is asking when we can expect the valuer bill. This question is directed at Sunil Agarwal.
Okay, I think the valuer bill has been sort of under discussion for a number of years. It almost reached the stage where it would have been presented to the parliament last year. But I think for some reasons and COVID and things like such, I think it was not presented. As a valuer community, we are expecting this to happen very soon. I think once this COVID is over and the parliament is in session, maybe the next session or the session after that, there is a large expectation that this should happen. And I think as a regulator himself, Mr. Verma also may be more aware because he is part of the IBBI as to when this is likely to happen. But I think from IBBI perspective, I know they're very serious. The valuation community is very serious. It should happen 12 months from now. If that's the guess I can take.
Yeah, I would not like to make any guess on the bill on the timing. So let's leave it at that. But yes, that will be a very good development and very positive for the sector. I have one question to come in. Vishendas ji.
Yes, please.
We have been talking about blockchain technology across different sectors, across different jurisdictions. And considering that we are talking about a digital drive for the mortgage industry, for the mortgage sector, end-to-end kind of thing, which will bring in a lot of transparency, efficiency, risk mitigation, audit trail, everything. Do you think this, happening anytime in future? Could it be part of the roadmap where you have an important milestone for getting blockchain technology into the mortgage industry? We have digital repositories of property registries have been digitized. We have the CERSAI where the lenders are putting up data on CERSAI, that is digital. The credit bureaus are digital. So things becoming so digital, can we have a roadmap? What are your thoughts on that? If you could share.
Yes, very much so, because when you think about what we're trying to do, we're trying to get an independent valuation of a piece of information and a piece of data at a point in time. And so that's what we're sending it out for the valuer. And a lot of the discussions have been so interesting around how do we make sure the valuer doesn't have subjectivity? How do we have that consistency of that information? And how do we have that flow of that data to the lender, to the regulator, to the title, to CERSAI, as you say, all the way through? And when you think of all the touch points of that information, and all the people that have the opportunity potentially to make a mistake, that's where the technology, and particularly blockchain technology, can really be quite game-changing, because it's the things about blockchain is it's secure, it's immutable, and it's captured as fact. And so very much you can have the blockchain's contract of sale, and all that valuer data can be put in and captured as a field, and then very much be recorded in a blockchain, so nobody can change it, and it's fact. And all the pieces of the information of the size of the property, the land, etc., can also all be captured. So we're actually looking at a proof of concept globally with one of the big valuation firms and one of the big banks. So it's very, very relevant. I guess it's just another example of the secure technology that can overlay across that flow. But certainly the beginning of that flow is the digital workflow, and that best practice flow of random allocation to valuers and capturing that data, and then quality control and benchmarking to know that that is correct, and we can rely on that fact-based piece of information.
Sure. Thank you.
It's a great question.
Yeah. So one last question. Some Raja Sham is asking from Cameron Weislage. He's asking a question particularly from you, Cameron, about the role of velocity.
Sure.
Can you brief?
I will just add, Professor Ashok. It is like after seeing the slide, I initially thought it is an application for valuers or for the bankers. Then secondly, later on, I thought, no, it is a automatic valuation model, like she explained, like it's a blockchain kind of thing. Then in the last slide, I thought, no, they are trying to become a regulator. So I'm literally confused. What exactly the objective?
Fabulous. Okay, thank you for the question. So I wasn't talking about Velocity, but Velocity is the company that I started in New Zealand, and then now in Australia, and now in India. And we are the platform that does the end-to-end. So in India, you have, and it was great to hear Mr. Sunil's discussion around HDFC and the problems in the India market. And so the problems you have lots of small valuers, 1 or 2 man bands. There's no quality control. How do you know if it's a good valuer or a bad? How do you get the good data? And so what Velocity does is it's the technology platform that connects the valuers to the banks and helps you have the digital valuation process. So we onboard all your valuers, we create a template, standardization, and then we send it to the valuers and we capture the data. We give the valuers a tool. And so we give them that tool because we know in India, there's issues around data quality and valuers can't invest in technology. So the valuer has access to an app, and every bank's template can be preloaded in the app. They complete the valuation digitally, and it does the quality control of the information. It comes back to the bank, And for the bank, they then know they can rely on that data. And so I think you touched on very much the data quality. So we're building that. Right now, we have thousands of valuers doing valuations, and all that information is coming back, creating a secure valuation. And the bank can then see which valuers are doing good jobs, which valuers are doing bad, who's delivering, who's not, and start actually that process of best practice and validation of valuers. So Velocity is the mortgage valuation platform that connects the valuers and the banks and captures all the data and makes that flow streamlined to bring transparency and efficiency.
Okay, fine. The objective appears to be fine, but this is a very much professional kind of thing. So anyway, it is debatable. Thanks for giving your opinion.
Okay.
I may be not very much convinced, or Mr. Sunil Agarwal also might be not convinced, but it is to move forward, and later on we will definitely discuss on the different aspect which you have expressed to us.
No, I think Raja, you assume that I am not convinced, but I am very convinced that that is the
It may be debatable. I said it may be debatable.
I'm sorry.
Okay, it's fine.
Clarify.
Yeah.
Yeah.
I think
Can I ask one question?
Yes.
Can I ask one question, sir?
What's your name?
Sir, I am Mallikarjunappa from Central University of Kerala.
Yeah, so be brief because we are running out of time.
Yeah.
So this will be the last question.
Yes, sir. During global financial crisis, we had seen asset securitization and credit default swaps were at the center of controversy. Do you see such a trend in the current property market in India and also at the global level? Any of the panelists could take this.
Sorry, what was the question? Are we seeing a trend of property values going down?
No, I'm talking about what is the percentage of the total lending that is securitized, that is number one, and then how much of that is in the form of credit default swaps.
Mr. Mallikarjun, can I respond to that? Because we
Yes,
are talking about the
yes,
valuation,
yes.
etc. So let me have the opportunity to respond. One is the global financial crisis was essentially based on the subprime mortgages. There are a large number of subprime mortgages, and that was happening. The lenders were giving loans to the individuals who did not deserve that, who didn't have the repayment capacity. So a whole lot of due diligence which was thrown to the winds, and a mass of subprime mortgages started sitting on their balance sheet, which their loans were given at very high interest rates, and they started securitizing that and throwing it outside their balance sheet, selling it to different, packaging it and selling it through different brokers and agents who were very highly incentivized. So their incentives were totally misaligned to the kind of work they were doing. So there was an environment where the substantive underlying of the loans were highly defective, and they were not the mortgages which are normally done in the normal way. As far as India is concerned, two things. One is lenders are very careful in lending, and subprime, we don't see the development of subprime loans in India really. It could be in the informal sector where the lenders are taking a well-informed call for improving home ownership in the country. So they are lending after proper due diligence, etc., and which also should happen. So they are developing this expertise for lending to the informal sector, which is very different from the kind of loans which are happening in the US. And there, once they started giving loans to these people, and once the property prices started coming down, the defaults started happening. Indian market is not like that. It's basically the consumer market, and people hold on to their properties and they would like to pay back the debt. So there is a difference in the psyche of the Indian population, which we have seen. That's one of the reasons why the NPA in housing sector is very low, particularly individual loans, because they are the consumers, they're the end users, the owners who are going to live in that house, and for them, the repayment of the debt is very high on the priority. So they do everything possible to pay back that loan. So these are two basic differences. Of course, we can talk about it at length, and there are so many other factors which also were responsible. But since you talked about the mortgages, it was essentially linked to the subprime mortgages.
Yes, thank you very much, sir. Thank you.
So friends, let me say a few words in the conclusion. All good things in life come to an end, and this particular webinar can be no exception. my heartfelt thanks on behalf of EGROW Foundation, on behalf of Dr. Arvind Virmani, Charan Singh, and all other my co-directors in the EGROW. I extend warm thanks and heartfelt thanks to each one of you, in particular, Shri Verma ji, Saligram, Mr. Agarwal, and Cameron, all and then participants. Before we allow you to let go, I have one small announcement. On the next week, that is on 28th May, there will be prolific speaker, Shri Shiv Shankar Menon, who had been the foreign secretary and the national security advisor. He will talk at 5:30 on India and Asian geopolitics, the past, present, and the future. He had written his recent book, and he will be covering that book beyond it. It is going to be very, very nostalgic, and I request all our participants to join. That is one. And second announcement will be the today's discussion, and we will circulate the recording of this by tomorrow afternoon. So this is one thing. And once again, thanks to each and every one, particularly all our four panelists, including a chairman of the session, Verma ji, and to each one of you. And it's my heartfelt thanks to you. Thanks. And
Thank
with
you.
this, and maybe Charan, I don't know whether he's in a position to speak. If Charan wants to add something before we call it a day, it seems.
I simply want to thank each one for such an excellent presentation. And this is an expert group which has given their opinion. I don't think we could have had a better session on property valuation that we have just had. Thanks to Mr. Verma to have put the panel together and taken the challenge of the whole thing being conducted so beautifully on a topic which is so specialized, as you have seen the interest of the speakers and the questions, so obvious that we have brought something new to the Indian audience and to the Indian readership, as well as scholars in the country. No words to thank Mr. Verma. Thank you very much.
So much, Charanji, and wish you a very speedy recovery. And we look forward to seeing you soon. Very much.
So thank you very much.
Thanks. Thanks. Bye-bye.
Okay.
Bye, everyone. Thanks, everyone.
Bye.
Thank you.
Thank you. Thanks. Bye-bye.
Thank
Good
you.
night.
Thank you. Bye. Good night.